Welcome back to Iron Financial. This is the channel where we forge stronger portfolios by putting companies under some serious pressure. I'm your lead analyst. You know, earnings season is heating up, and today we've got a fascinating name right here on the anvil, Aris Mining. Ticker is ARIS. They're just about to report their latest numbers, and believe me, the market is completely split on this one. So today, we're going to put this company under the forge, we're going to heat it up, hammer it out, and see if it's a portfolio cornerstone or just a major point of structural weakness. Let's get right into it. And that really brings us to the big question, doesn't it? Is Aris Mining actually forging real, tangible value, the kind of stuff that builds wealth, or is this just another story stock glittering with the promise of fool's gold? You've got two incredibly powerful and completely conflicting narratives swirling around this company. On one side, you've got this story of just explosive growth and operational mastery. But on the other, you've got these glaring red flags popping up around revenue, valuation, and some pretty fundamental risks. Our job today, to dissect both of those narratives piece by piece and figure out which one is built on a stronger foundation. Now, before we get too carried away with all the promises of the future, let's just ground ourselves in what's real right now, okay? We're not talking about some tiny speculative exploration company here. Aris Mining is a significant player in this space. We're looking at a $4 billion market cap gold producer. And their operations, the very engine of this whole enterprise, they're located primarily in South America, specifically Colombia and Guyana. Now, that geographic fact is absolutely central to both the bull case and the bear case, and it's something you really need to keep in the front of your mind as we start to drill down into the data. To really hammer this thing out, we have drafted a very clear blueprint for our analysis. First, we're going to fire up that growth engine and take a hard look at the powerful bull case. Then, we're going to flip the coin and start looking for cracks in that foundation by laying out the bear argument. After that, we'll stress test the balance sheet to see if it's true bedrock. Then we'll gauge those very real jurisdictional risks. We will pit the price against the promise in our valuation segment. And finally, we will forge our final verdict. Okay, let's dive right in. The entire bull case for Aris, the story that has investors willing to pay such a steep premium, it's really built on one massive, powerful pillar, growth. And I'm not talking about some minor incremental growth either. We are talking about transformational, company-defining expansion. This is the narrative that management is out there selling, and frankly, the numbers they are projecting are incredibly compelling. Just look at the velocity of this production ramp-up. It's staggering. And this isn't some long-term dream they're talking about. This is happening right now. In 2025, production came in just shy of 228,000 ounces of gold. Okay, not bad. But look at 2026. Their guidance leaps to a midpoint of 325,000 ounces. That's more than a 40% increase in production in a single year. This isn't just speculation, folks. It's being driven by tangible expansions at their Segovia and Marmato mines that are already well underway. The engine is clearly firing on all cylinders. But listen, 350,000 ounces, that's just the next milestone on their roadmap. It is not the final destination. The real prize, the grand vision they're selling to long-term investors, is this number, 1 million ounces of annual gold production. This is the company's stated long-term outlook. Now, to understand the scale of this, moving from roughly 250,000 ounces to 1 million would catapult Aris into a completely different tier of gold producers. It would make them a senior producer, a name that big institutional funds simply can't ignore. This is the ultimate payoff. It's the reason the market seems willing to overlook some of the issues that we're about to get into. And this isn't just some number they threw into an investor deck. The heavy lifting, and I mean the literal earth moving, is well underway. What you are looking at right now is the construction of the new CIP plant at their Marmato project. Now, CIP stands for carbon in pulp. It's a critical processing method for pulling gold out of ore, and this new facility is an absolute game changer for this asset. The company reports this whole build-out is on schedule, with the very first gold pour expected in the fourth quarter of 2026. This is tangible evidence. We're talking steel and concrete that the growth story is real. They are building the infrastructure to make that million-ounce target a reality. All right, hold on. That is a powerful narrative. 1 million ounces of gold, you've got the construction photos, production charts all pointing straight up. It is a very compelling story. I get it, but a compelling story does not guarantee a solid investment. Here at Iron Financial, it's our job to apply pressure. So now it's time to stop admiring the architecture and start looking for the cracks in this foundation. And believe me, there are some significant ones. And the first crack we find, well, it's a big one. It's more like a fissure that runs right through the heart of the company's credibility. An analysis from Guru Focus puts it bluntly. The company has struggled to exceed revenue expectations, achieving this only 13% of the time. Just let that sink in for a second. 13%. That means over the last 2 years, they've only managed to hit their promised top-line number 1 time out of 8 reporting quarters. That is not a rounding error. That is a consistent, established pattern of overpromising and underdelivering on revenue. This slide reveals the core issue, the real puzzle at the heart of Aris Mining. On the left, you see earnings per share, a perfect 100% beat rate. Every single quarter for the past 2 years, they've beaten Wall Street's profit expectations. That's impressive, no doubt. It shows they have a firm grip on their costs. But then you look to the right, revenue, a dismal 13% beat rate. What this tells us is that while management is excellent at financial engineering to hit a bottom-line number, they are consistently failing to deliver the top-line sales growth they promised the market. It really begs the question, is that profitability truly sustainable if the revenue foundation is this weak? And it gets worse. This isn't just about missing a few quarterly forecasts. The company's 3-year revenue growth rate is actually negative 3.9%. So their top line isn't just underperforming Wall Street's expectations, it has actually been shrinking over a multi-year period. While management is out there painting this beautiful picture of future growth, the hard historical data shows the reality of revenue decline. So how can you confidently bet on a massive expansion story when the existing business has actually been contracting? That is a fundamental contradiction right at the heart of this investment thesis. Okay, that's a fair and critical point. The revenue history is a flag, and you can't ignore it. But the bull case argues that you're looking in the rearview mirror while the company is building a superhighway right in front of you. And to build something that ambitious, you need a rock-solid foundation, not of promises, but of cold, hard cash. And this is where the bear argument really starts to hit a wall. We have to examine the balance sheet bedrock, the financial fortress that underpins this entire growth story. And this, right here, is where the company's financial strength becomes undeniable. Aris is built like a fortress. First, they are sitting on a war chest of over $390 million in cash. Next, their net leverage, which is just a company's debt relative to its earnings, is a tiny 0.25 times. That tells us they are not overextended or beholden to creditors in any meaningful way. The result? Less than $88 million in net debt. For a multi-billion-dollar company in a capital-intensive industry like mining, that is an incredibly clean and powerful balance sheet. So what does all this mean? It means they don't need to take on risky, expensive debt to build their future. That $322.1 million you see, that's the cash flow their existing operations generated in 2025. And the key takeaway here is that this cash flow fully funded all of their growth and expansion initiatives. They are a self-funding growth engine. The revenue weakness might be a problem from the past, but this cash flow is the high-octane fuel for tomorrow's growth engine. It's what gives their promises real financial backing. Okay, a strong balance sheet is a powerful asset. No one can argue with that. But the strongest fortress built on an earthquake fault line is still a fundamentally risky structure. And that brings us to the next critical stress test. We've examined the company's financial foundation, but now we have to question the stability of the literal ground this company operates on. It's time to gauge the jurisdictional risk. A quick look at the company's own map reveals a critical vulnerability. This is not some globally diversified mining giant. Their core, cash-generating assets are highly concentrated in Colombia, with major development projects in both Colombia and Guyana. These are not, to put it mildly, the world's most stable and predictable operating environments. We are talking about regions with long and complex histories of political change, regulatory shifts, and economic volatility. This high degree of geographic concentration is a major, undiversifiable structural risk. And hey, you don't have to take my word for it. This text is pulled verbatim from the risk factors section of Aris Mining's own legal filings. They are telling you themselves, in black and white legal language, changes in national and local government legislation, political or economic developments, uncertainties relating to the enforcement of civil liabilities. They are explicitly warning investors that the rules of the game can change without notice, that permits can get delayed, and that legal protections may not be what you'd expect. This isn't a bare speculation. It's a disclosed material risk coming straight from the company itself. So let's just recap the bear case so far. We have this compelling story of massive future growth, but it's undercut by a documented history of revenue misses and actual decline. This is all built on a financial foundation that, while strong, is located on geopolitically shaky ground. So what's the last piece of this puzzle? What price are investors being asked to pay for this mix of promise and peril? This brings us to the final pillar, valuation. Are you paying for performance, or are you paying a steep premium for a promise? Well, the third-party valuation assessment from Guru Focus, it really doesn't mince words. Their conclusion is blunt: significantly overvalued. Their GF value, which is an estimate of intrinsic worth, sits at just over $6 a share. That's not a small discrepancy. It suggests the market has already priced in every single bit of the good news, the production ramp-up, the million-ounce target, and has left absolutely no margin for error or for any of those jurisdictional risks to actually materialize. And just how extreme is that valuation? The price-to-earnings ratio for Aris Mining is a breathtaking 79.8. The median for the entire industry, just 8.34. Now, bulls will argue that growth companies always command a higher PE ratio, and that's true. The market pays up for future growth. But the question you have to ask yourself is whether this growth profile warrants a nearly tenfold premium. To justify that kind of valuation, you need flawless execution. But, as we've already established, there's a troubling history of revenue misses. You're paying a Rolls-Royce price for a company that has to navigate some very, very rough roads. That's a dangerous combination. All right, we've run the bull case through the fire, and we have hammered on the bear case. We've seen the powerful story of growth, and we've exposed the very real cracks in the foundation. Now it is time to bring it all together for the final verdict. The fundamental question for any investor isn't whether there are risks. There are always risks in mining. The real question is whether the potential reward justifies them, and whether the structure itself is sound enough to withstand the pressure that lies ahead. The conflict here is crystal clear, isn't it? The bull case is a promise of massive, fully funded production growth, and it's backed by a flawless record of hitting profit targets. The bulls will tell you the market is rightly paying a premium to get in on the ground floor of what they see as a de-risked growth story. But the bear case points to these troubling problems: a history of missing revenue targets, a valuation that's 10 times the industry average, and it's all built on the shaky ground of Colombian and Guyanese politics. The bear argument is simple. You're paying a premium price for a bet that the future will look nothing like the past, in a place where the future is notoriously unpredictable. Ultimately, your investment thesis boils down to this single question. If you're an investor who believes management can execute on this ambitious 1 million-ounce vision, and you believe the jurisdictional risks are well managed and already priced in, then the current structure looks less like a risk and more like a launchpad. That high valuation is simply the price of admission for what could be a premier growth story in the gold sector. It's an opportunity. But if you're an investor who believes that past performance on revenue is a critical indicator of future challenges, and that a PE ratio near 80 leaves zero room for any operational stumbles or political headwinds, well, then this looks less like a solid foundation and more like a structure built purely on hype. It has all the markings of a classic trap, priced for perfection it may never achieve. And that brings us to the final question you must ask as Aris prepares to report its numbers. Is this a solid foundation for growth, or a structure built on hype?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.